Okay, so let's talk about the biggest story in the economy right now, and that is the promise of interest rate cuts. But here's the thing, there's a huge gap between the official story that we're all being told and the actual financial reality that so many of us are living through every single day. So let's break down what's really going on. And this really gets to the heart of it. Economic policy, it isn't just about raw numbers and data. It's about the story they use that data to tell. Our job is to understand the story they're trying to sell, even if it doesn't quite feel right in our own wallets. And that brings us right to our first major disconnect. You've got the official inflation number, and then you've got your actual grocery bill. So according to the latest official report, the CPI, or Consumer Price Index, inflation has cooled all the way down to just 2.4%. Now, on paper, that looks fantastic, right? It's really close to the Federal Reserve's target of 2.0%. And this one little number is pretty much the foundation of their entire news story. But it's so important to remember that this is just a broad average, and averages can really hide the pain points in a real person's budget. It's a simple question, but it's probably the most important one. I mean, think about it. When you go to the grocery store, when you're paying your bills, does it actually feel like prices are only up 2.4% from where they were last year? Yeah, for most people, that's going to be a hard no. And this slide, well, this slide shows you exactly why. Let's just forget the headline number for a second. Look at the real world. Ground beef is up over 16%. Home healthcare, up 12%. Hospital care, 7%. I mean, even funeral costs and public transit are up 6 and 5%. These are things people have to buy, and the price hikes are way, way higher than that official 2.4% number. This is the reality. Okay, so if the inflation story is, let's say, complicated, what about the whole reason for cutting rates in the first place? Well, this brings us to the Fed's justification for all this, and as you're about to see, their story has just completely changed. You see, the original story, the narrative we were hearing for a while, was that we might need rate cuts to save a weakening labor market. But the data just doesn't back that up anymore. Not at all. The last jobs report showed 130,000 jobs were added, and the unemployment rate actually fell again to 4.3%. The labor market is solid. It just doesn't need rescuing. So, what does the Fed do when the facts don't fit the story? Well, they pivot. The old story is out the window. The new story, as you can see here, is that because the labor market is doing great and inflation is officially low, now is the perfect time to cut interest rates. The whole justification has done a complete 180. So you gotta ask, why the sudden shift? Why this rush to find a totally new reason to cut rates? Well, the answer might have less to do with economics and more to do with politics. Let's just take a quick look at the calendar. We've got Fed meetings in March and April, and Jerome Powell is the chair. But then come mid-May, a new Fed chair, Kevin Walsh, is expected to take the helm. And wouldn't you know it, the very next meeting is in June. Now, this is where it gets really interesting. Look at how the market is betting on this. For the April meeting under Powell, there's a more than 71% chance of no cut. But then you fast forward to the June meeting under the new expected chair, and the odds completely flip on their head. Suddenly, there's a 68% chance of a cut. The market seems to be saying that the new guy is going to be much more eager to start cutting. Okay, so with rate cuts looking more and more likely, what does this actually mean for investors? Well, while it's generally a good thing for the stock market, it's absolutely crucial to understand that this is not going to be a rising tide that lifts all boats, especially not with a massive disruptive force on the scene, artificial intelligence. This is the question every single investor needs to be wrestling with right now. Sure, lower interest rates might give a company a boost, but they're not going to save a business whose entire model is about to be made obsolete by AI. You have to be able to separate the survivors from the casualties. And this really comes down to the idea of a moat, what protects a business. So take Duolingo. It's a cool app, but really, why would you pay for it when a free AI like ChatGPT can create totally custom language lessons for you? It doesn't really have a moat. Now compare that to Amazon. Amazon uses AI to get smarter and more efficient, but AI can't just magically build warehouses or deliver packages to your door. Amazon has a massive physical, logistical moat that AI just can't touch. Now, while the story for a lot of tech stocks is pretty complicated right now, there is another asset class where the narrative seems a lot more straightforward, and that's gold. Gold is basically benefiting from what you could call a perfect storm, a trifecta of tailwinds. First, you have de-dollarization, this trend of countries moving away from the US dollar and buying more gold for their reserves.
Second, you have continued money printing. And third, the big one we've been talking about this whole time, upcoming lower interest rates.
And the logic here is actually pretty simple. When the Fed cuts rates, what happens? Well, the return you get from a safe investment like a savings account goes down. So if you're only earning, say, a measly 2% at the bank, while inflation is still eating away at your money, suddenly holding a safe haven asset like gold, which doesn't pay a yield, starts to look a whole lot more attractive. So here's where we land. The stage is set for rate cuts, and that's creating a powerful tailwind for assets like stocks and gold. But running just beneath the surface of that story is this massive wave of disruption from forces like AI. So the real question you have to ask yourself is, how is your portfolio positioned for both the story and the reality?